My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to make you a little money. My job, not just to entertain, but to educate, teach. Call me at 1-800-743-CNBC. Tweet me at Jim Cramer. On a day where the Dow inched up 38 points, S&P dipped 0.16%, NASDAQ declined 0.3%, I'm willing to declare that there's too much doom and gloom out there. Look, I'm not trying to call bottom. I want to make that crystal clear. But I think it's worth taking a hard look at what's actually going right, not just what's going wrong. Look, the market's up so much for the year as we head into a tricky election and enter what's historically the worst month of the year. So only a fool would ring the all-clear klaxon. Plus, we aren't even oversold, at least according to the S&P oscillator that I swear by, a gauge that identifies when there's too much buying or selling versus normal times. You don't go in when the market's overbought like it is now. It almost never works. But at the risk of sounding too bullish, let me try to refute some of the biggest and baddest stories out there. First, there are many themes floating around Wall Street ether. The chief one right now is that the economy is slowing at a much faster pace than the Federal Reserve is prepared to combat. Therefore, we're doomed to a recession. That's why the consumer packaged goods stocks and the utility stocks are roaring, while the economically sensitive stocks have indeed been crushed. I don't deny that the economy is weakening. You don't get the collapse in prices of Dollar Tree off 55% for the year, including today's 22% beatdown in the wake of a very weak quarter, or Dollar General with another disappointment just last month without a weaker economic backdrop. Well, what do you expect? See, we can't hope for the Fed to bless us with a rate cut or rate cuts unless the economy's deteriorating. They don't cut rates when business is good. You can't wish for a rate cut and not accept that there are going to be some blow-ups. That's just foolish. Yet we all act like nothing should go wrong and we'll get multiple rate cuts anyway. Like we're rewarded with that? Wrong. They're meant to combat economic weakness, not strength, for heaven's sake. At the same time, people forget that the Fed will take rates down precisely in order to prevent a recession. Yes, I'm sure if we get a really weak labor report on Friday, we'll see a huge rally in the recession-proof stocks again, even if they could be hurt by political meddling. Or in the case of the food and beverage plays, the rise of these GLP-1 drugs. Of course, if non-farm payroll number is too strong, then we can't have the rate cut cake and eat it too, can we? How about the tech weakness as a sign of recession? I keep hearing that Nvidia might have missed its quarter because of economic weakness. Hey, can we just please put that aside? The people saying this are the same people who call the stock Nvidia like it rhymes with Nivea or something, you know? I mean, like it's this instead of Nvidia, which is how you pronounce it. The simple fact is that Nvidia's problem is that it couldn't produce enough of its high-end Blackwell chips. It was supply, not a lack of demand. Can't they give these people a pronouncer? Like, don't call it that. Now, we know from the last round of semiconductor conference calls that we've seen a bottom in all sorts of inventories, including cell phone and industrial. That's excellent news for Micron, which has been in free fall. Marvell Tech, which would be much higher if it weren't for recession chatter. Something at Texas Instruments seems to have already shaken off. How about oil as a sign of weakness in the economy? Come on, you're hearing that too, right? I'm not buying it. Although it's possible that there's a demand weakness. That would be from China, not here. We're simply pumping oil like mad here. Oh, by the way, maybe this is it. If Trump wins, we could see the same thing as we did last time when he won. Oil stocks underperform. Yes, when the president supports oil drilling, it brings a ton of oil to market. It ends up suppressing the price of crude. We're that big a producer. Maybe that's the real source of weakness. Now let's deal with the most insanely prurient and misleading hokum currently being dispensed right now. Again, concerning not Nivea, but Nvidia. There's nonstop chatter that the hideous decline in Nvidia stock yesterday, one that destroyed $279 billion in market capitalization, is an arbinger of disaster. In isolation, that sounds pretty frightening, but allow me to offer an alternative view, please. Nvidia started the year with a $1.22 trillion market cap. It then zoomed to $2.93 trillion by the end of August. Yesterday, it declined to $2.65 trillion. Perhaps, just perhaps, that big $279 billion loss isn't so big, at least in the context of a stock that's up more than 100% for the year. Oh, by the way, let's not forget about the law of large numbers. When you have a couple $1 trillion stock, $200 billion ain't that much. Oh, and this wasn't the first time that Nvidia's market cap dropped more than $200 billion in a day. In fact, this was the 5th time. Big deal, but not too big a deal. I know what you're thinking. Nvidia stock is on fragile ground. Now, that's actually something I agree with, as there are still way too many fellow shareholders who don't know what Nvidia is, what it makes, or how it profits from all the brainpower of CEO Jensen Huang and this amazing team. Let's call it the Nvidia factor. These clueless investors all have to sell. The stock can't get a firm footing until these sunshine shareholders capitulate. At the same time, we don't know how quickly Nvidia can get its Blackwell chip rolling or how it can get its gross margins up. By the way, that was actually the real reason for the stock's pummeling in the wake of the so-called weak quarter, their gross margins. But how about something more empirical? Deutsche Bank put out a list of the biggest previous drops in the market, and it's pretty revealing that these tend to be great buying opportunities. For example, Meta Platforms shed $251 billion in market cap on February 3rd of 2022, but since then it's rallied 116%, trouncing the S&P's 23% gain over the same period. On April 29, 2022, Amazon lost $206 billion in market cap. Since then, it's rallied over 39%, beating the S&P, which is up 33% and change. On September 3rd of 2020, Apple lost $180 billion in market cap. Since then, it soared 83% versus a 60% gain in the S&P. On October 25th of 2023, Google dropped $180 billion. Since then, it's come back with a 25% gain. Not bad, but it's the only stock on the list that failed to beat the S&P, as the index jumped 32% in that time. Finally, Microsoft lost $178 billion in market cap back on March 16th of 2020, then went on to surge, a rampage, 202% versus a 131% win for the S&P 500 over the same period. After examining these figures, you could easily argue that the real winners tend to experience a terrifying degree of volatility. It often scares people out of these stocks when they should be buying more. Every one of these moments was ultimately a terrific price to buy, not sell. Finally, let me tell you something else that might cut through the gloom with a machete. If you have a market that's been driven by a handful of stocks, and then suddenly it's being driven by healthcare, consumer packaged goods, and financials, utilities, are we to presume that's somehow a bad thing? If everything were to go down, sure, real bad, but not this time. The bottom line, we have a ton of stocks that are rallying here, giving us much broader leadership. Again, like the rate cut that's coming, isn't that exactly what we want? Isn't it? William in Connecticut. William.
Hey, Jim, my 11-year-old son, Will, has a question for you.
Sure. Oh, yeah.
I was studying stocks for my 5th grade class, and one stock that was doing really well was Royal Caribbean. They added a new ship to their fleet, and the stock almost doubled in value in the past year. Is it still a buy?
Boy, there's a kid with horse sense. I got to tell you something, William. Listen to me. This is the best operator right now. They're doing a terrific job. Even the others are not. The others are kind of faltering, but not these guys. I think it's a great long-term investment. People did not decide to leave sailing during COVID, and they've embraced it more than ever now. Robert, New York. Robert.
Hey, Jim. How you doing tonight?
Not bad, Robert. How about you?
Good, Jim. I'm doing great. I couldn't be doing any better because if you recall when we had our conversation a few weeks ago, we spoke about a stock that you recommended at 19, and I rang the register when you said it'll go into the 30s, and I had 4,000 shares. You made me 40 grand, baby, on Chewy, and thank you so much. Does everybody remember that? Does everybody in America remember that conversation Jimbo and I had?
I appreciate it. I appreciate it. My team does. Yeah. The team that's been with me forever understands. Thank you for bringing it up. I really appreciate it.
Because, Jim, I religiously listen to everything you say, and you are the man, okay?
But remember, I make mistakes. I own them, but I make them, okay?
Maybe you make 1 out of 100 mistakes. I haven't seen too many, but it's my opinion. I mean, I think you're
everything
right on
I
the
do with
mark,
my
Jim.
trust is public, so you can just count the errors if you want to. But thank you for those kind words. Thank you.
Thank you, Jimbo. Anyway, Jim, this next stock has a huge lead in the weight loss industry. Sometimes it's very hard to own winners during a periodic sell-off. But this drug company, in my opinion, I'm sure you're going to agree with me on this one, and they're going to hit that bell for me, could be the next trillion-dollar company, okay? Their diabetic drug alone, Mufanda, got approval in China, and China is the most highest diabetes in the world, okay? Yeah. So the bottom line is this. The company is expected to see about 120% earnings growth this year and 40% next year. GLP-1, Jimbo, Eli Lilly.
Okay, I think, first of all, those comments were extraordinary. Thank you, Robert. Eli Lilly is going to be, I believe, yes, the next trillion-dollar company. It's $900 billion. And I think that it's just been remarkable. We did trim some this week because I felt so greedy for the charitable trust. I hadn't taken any profits in a long time. But, yes, we did that so we might be able to buy some if it comes back down. Thank you so much. Let's go to Ian in North Carolina. Ian.
Jimmy, how we feeling about your birds tomorrow?
Well, we're going down to Brazil. I talked to Harry Roseman. He says they're on the plane. They were on the plane. I tell you, I like it because it's on NBC and on Peacock. There you go. Because I play for us. What's going on?
I love it. Well, listen, I am personally pretty bullish on the long-term secular trend around rare earth materials. Am I on the right track with MP Materials?
They are now a show-me story. I've got to tell you, I've been backing them for a long time, but I am not going to back a company that has not been able to capitalize off of what is an absolutely important, incredibly advantageous position they have, and they're not making money. And that's why the stock is down 30% for the year. Okay, we have a ton of stocks rallying right now. It's healthcare, finance, utilities. Come on. We're getting broader market leadership. We're getting rate cuts. My question is, are those bad things? Mad Money tonight. Should you stock up on Sprouts Farmers Market after the late July report? I'm checking with the CEO to see what the fresh food retailer has in store. Then Dick's Sporting Goods falling after earnings. So what's behind the move? I'm cracking open my post-earnings playbook. And do not miss my exclusive with defense player AeroVironment, straight off the company's after the bell report. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.